Good afternoon, and for some of you, a good morning and a warm welcome to everyone who's joining us today. This is the third themed discussion we are having as part of the COVID project, a collaborative research project coordinated with the German Development Cooperation and the International Food Policy Research Institute. This project aims to explore whether or not South Africa's policy responses for this unprecedented COVID-19 pandemic shock were appropriate. After having looked at recovery policies applicable to monetary policy and the labor market, today's discussion focuses on how we can model and develop South Africa's international competitiveness post-COVID-19, bearing in mind that we are a small, open economy. Joined by an international team of panelists, we welcome you to today's discussion entitled International Perspectives and South Africa's Trade Policy. Coming to you from the ERSA offices in Cape Town, my name is Margot, and we look forward to hosting you. As always, a few housekeeping rules. We encourage as much participation as possible and love hearing from you. So please send us your comments and questions in the Q&A and chat features, which you'll find at the bottom of your screen. And we'll incorporate them into our live discussion as best we can. Should you have to leave the webinar prematurely, we ask that you please share your feedback with us in the feedback link. Now, without further ado, to introduce our distinguished discussants, I'd like to hand over to ERSA's Executive Director, Matthew Simmons, who will be chairing the discussion also. Thank you, Matthew. Over to you.
Thank you, Margot. And yeah, good afternoon to everybody and welcome. It's a great pleasure to be chairing this session and to be part of this program with IFPRI and GIZ. So today, I mean, those of you who've attended these sessions before will I'm sure we have recognized a pretty informal approach to the conversation and discussion, which we'll be looking to replicate during the course of the day. We're going to start with a short contextualization by the authors of the papers that are the basis of the discussion today. So Sherman Robinson from IFPRI will be introducing his paper, followed by, well, not his, the paper that he was a co-author in, and then Matthew Stern will be introducing the paper that he was a part of. We then have, we call them discussants, but really we're all here to share our views and make a contribution. Mariam Mativ from the Gibbs Institute, Business Studies. And we have Montfort Mlachila from the International Monetary Fund, giving us both an international perspective, but also Monty was here resident in South Africa with the IMF not too long ago, so he does know the environment very well too. So without further ado, handing over to Sherman to give us a quick introduction to some of the issues that we're going to be discussing.
Let's see if I can share the screen. Okay, this is working. And you can see this, I hope. Okay, so I'm going to basically gallop through a comparative paper done with a whole bunch of co-authors, following up on starting with work we did on South Africa and then expanding to other countries. And we're basically modeling the economic impacts of the pandemic and the economic mitigation policies of a bunch of different countries. So what we're really seeing is a infectious disease, nasty, worldwide, and the policy response was basically industry and household lockdowns. And they just led to a catastrophic collapse in economies across the globe. And the collapse was unprecedented in how speed and how deep it was. So we found, for example, when we were looking at it, the quarterly data was just missed a lot of the action. We had to move to monthly data when we were looking at this. In many ways, it's like a natural disaster. It's like a flood or a hurricane or whatever, except we don't destroy the capital stock. We just close down the economy. So what we ended up with is something unprecedented. We ended up with recessions across the globe in all these countries, but it's a bottom-up recession. It originated in the supply-demand crash at the deep sectoral level, focusing starting in the service sectors, and then spreading across supply chains. And then it also then led to an aggregate demand shock, which looked more like a standard recession. So that the bottom-up recession started it, and we ended up with some features of a standard recession with investor uncertainty, a complete collapse of investment, trade collapsing. That's where we are. What I'm going to focus on is the bottom-up nature of this should lead to a different policy response than we get in standard recessions. The policies to mitigate were basically efforts to keep labor employed and earning. That would be the goal. So you saw that across Europe, for example, where they actually paid firms to maintain employment, not fire people. You want to keep the firms alive, so you subsidized them, but then you also did income support and poverty and household income support, focusing on poverty in the low-skilled labor markets that were especially badly hit, plus the safety net programs. So you had a mix of policies. The idea that the theory behind it was to just put the economy in hold. You weren't trying to stimulate the economy. That was not possible because it was closing down, but put it on a hold so that when the pandemic was brought under control, you can recover efficiently. In the event, a lot of that didn't happen in a lot of countries. So you ended up with people just didn't have the policy mix to be able to do that mix of policies. So when we look at a recession, the standard way of looking at it is look from the top down. Most recessions originate in the asset markets, a collapse of investor confidence. In our case, various terrible financial instruments like collateralized mortgages markets collapse. So you end up with it then trickling down to the real economy. And it takes time to do that. Most recessions kind of unfold over many quarters before they really hit badly. This one started at the bottom. It's a change in household industry behavior at very disaggregated level, and then fed up to macro aggregates. So modeling that really implies that you should start at the bottom. Instead of just taking some standard macro model and trying to adapt it to this, you should actually work where the recession hit. And you need to look at all the links across sectors, because that's important. While it originated in contact intensive manufacturing and mostly service sectors, it spread across the economy. So, and it ended up being national in scope, not completely focused on particular sectors. So we then start, when we look at this, we start with an accounting framework that captures the sectoral detail, but also links up with the macro accounts. So we use something called a social accounting matrix, which is in fact the data structure underlying the national income and product accounts in the United Nations and in most countries. So you actually get many sectors. The models we dealt with that I'll describe have well over 100 sectors. US model 184, South African model 100 and something. You really trace the circular flow of production from at the industry level with a lot of detail where the shock originally hit, and then feeding back to income to households, all the way back to demand for goods and services. So we track through all the indirect links in the economy. This database supports what we call SAM-based structural models, and they're widely used for this kind of analysis. In fact, they're widely used to look at natural disasters. So there are two families of these models. There are linear multiplier models, and then what are called computable general equilibrium models, both single country and multi-country, that focus on market interactions, and in the case of multi-country models, really focus on international trade. We chose to use a SAM multiplier model. They've been widely used to analyze lockdown scenarios. IFPRI is doing them in a whole bunch of countries. I will describe a comparison between South Africa, Mexico, UK, and the US, because it's very interesting to see what when we were doing this, what was the nature of the shocks and the similarities across countries. On the other side, you have CGE models that simulate the operation of markets with substitution possibilities and production and demand. So they really are simulating the economy in the way that we teach our undergraduates in economics. So you have changes in prices and wages, markets operate smoothly, which was not what was going on during the pandemic. But they are definitely relevant for the recovery phase when we're moving out back into long-term growth, something of particular relevance for South Africa, given where it started this in the crisis. So we do scenario analysis in the paper that I'm going to describe. We look at monthly shocks in US, UK, Mexico, and South Africa. And they all started in March, which was the beginning of the lockdowns, but roughly halfway through March, a little bit later in Mexico. Then in April, it really hit. That's the worst month in all the countries except Mexico, which started a little bit later, and it got hit worst in May. And then in June, you started to see a recovery. And since then, you've had ups or downs, but it's been smoother, a smoother process. So looking at the monthly data, here's a quick comparison of the four countries. And you can see South Africa is the developing country, Mexico, United Kingdom, US in terms of GDP, in terms of country size, economic structure. I'm not going to dwell on this, but you can see South Africa is our example of a developing country. In Africa, we've done a lot of other much poorer countries and also worked in China. So here's what happened on a monthly basis. And you can see South Africa had the worst hit, going all the way down, minus 40% in April. The other countries, less, but very serious shocks. Mexico, a little bit further down in May and then started to recover. And then by June, they were recovering. And after this period, while it's very difficult to get monthly data. So following this from the recovery on, we actually, in these countries looked at, and you had a presentation a couple of weeks ago from Sherwin Gabriel, where we showed the South Africa work. We moved back to a quarterly model. But in this case, we're doing it on a monthly basis. And you can see, this is what happened to employment. In all the countries, we could get a rough shot at unskilled labor and skilled labor break, some better than others. And you can see that basically the shock hits unskilled labor much worse than it hit skilled labor. But on the aggregate, it was a really big hit. I mean, we're talking 15, 20% of the labor force unemployed, even in the US, 20, South Africa, it went down to 50% in April. I mean, this is an unprecedented shock. The 2008 Great Recession in the US generated something like, 6-7% unemployment. Here in 1 month, we had it collapse by 20%. So you can see it was a really big shock. I have a whole bunch of slides which people who want to download it, they can, but I'm not going to talk about them here, where I compare the data, the model projections with actual data, and we do remarkably well during this period of the deep shock, tracking very closely to the actual data in the simulation model, which is a really validation exercise on the model. So basically, in all these countries, it really hit low-skilled labor and the least secure labor in all these countries. And the countries vary enormously in their social safety nets. Europe had remarkable social safety nets in place and was able to just activate them. UK, in Europe, probably the least generous social safety net in Europe. US, worse. South Africa, by developing country standards, has extensive income support for poor households. Less than European, but impressively good. And Sherwin discussed that a couple of weeks ago. very important for South Africa in its response. Mexico is the worst in our sample of countries, with basically virtually no support for either informal sector production or employment. So you basically hit poor households in all of these countries, and the result was in every one of them did serious support aimed at income support to poor households. That actually, of course, has a Keynesian multiplier impact. You're actually injecting income at the bottom of the income distribution. The households spend that money, which then induces a supply response, and you end up getting a real Keynesian multiplier, which helped mitigate the shock, and also when it kicked in, helped stimulate the recoveries, the coming out of the shocks. So we had the most dramatic fall in income and GDP in all these countries. We also had the most dramatic ever recovery in, again, all these countries. What we did then is ask the question, can we use the multiplier model to describe the state of the economy at the end of the shock, but before we recover? All these economies were damaged, and very similarly in the sectoral structure. And basically what we're now observing, certainly in the US, UK, is serious supply constraints along the supply chains on the recovery, with all kinds of shortages and whatever emanating mostly from the shocked parts of the economy. So what we've done for our analysis is saved the social accounting matrix the model generates for the worst part of the economy or later, and then using that as the starting point to look at the recovery. You heard Sherwin and Gabriel giving a talk about doing that in South Africa a couple of weeks ago. In the longer run, where you really want to look at structural changes and market interventions over the medium to long run, then the multiplier model we've been using is too short run. It has fixed prices and does a lot of quantity adjustments. You move to CGE models, and we are doing that. We've got one running for South Africa. We're doing it certainly for the US and Mexico. And we've also started working with multi-country models. I'm currently involved in doing some work on Africa to look at international trade issues, where we're looking at changes in the structure of production, exports, and imports as world trade recovers. So I'll stop there for the moment. We'll continue this discussion. We'll continue as we move on. So let me stop share, and we're back. And I think I made it within 10 minutes.
Thank you very much, Sherman.
It's a gallop to a lot of work.
Yeah. Thank you very much, Sherman. That was a very, very quick summary of an extensive and detailed paper. It is available on the IFPRI website, and I think we have a link to it on the ERSA website for those of you that are keen to get into some of this important work a little deeper. And yeah, hopefully through the discussion, we'll be able to tease out some of the more interesting findings within the paper. But handing over to Matthew Stern for a similarly brief and quick overview of another very extensive and interesting paper. And then after that, I will ask Marianne and Monty for just some quick reflections on what has been raised so far, and we will see how the conversation evolves from there. Thanks, Matt.
Oops, you're muted.
Oh yeah, hopefully I am now not muted, and hopefully you can also see my presentation. I'm having a very technically challenged afternoon. Thanks, everyone. Now, thanks, Matthew, for the introduction. Sorry to say that this presentation doesn't talk to COVID at all. Equally sorry to say it's both based mostly on a lot of thinking and not so much on modeling. But what Yash and I have tried to do in this paper is to look backwards and review South Africa's trade policy, trade performance, export performance over the last few decades, in order to understand, what more can be done in order to try and raise export growth in a post-COVID world.
Matt, can I just come in quickly? I'm not seeing your
Sure.
presentation. Are others seeing it?
Yes, I'm seeing it.
Right, it's lost in a second screen. I will go find it. My apologies for interrupting. It's
That's
Zoom,
okay.
We've only been using it for a year and a half. I'm still figuring it out.
Thanks, Matt. I'll take another 2 minutes for that. Okay. So, oops. No. As we are all aware, South Africa is a relatively small and very open economy, and has only got smaller and more open over the last 2 decades, and currently accounting for around 0.6% of world GDP. So as a small economy, we are very dependent on imports in order to satisfy consumption demand, but we are also highly dependent on our ability to export in order to grow and diversify our productive capacity, our production base. Unfortunately, looking back over the last few decades, South Africa's overall export growth rate has slowed quite dramatically. So from 2000 to 2009, South Africa was growing more or less on par with the world average. But from 2010 to 2019, South Africa's export growth rate has more than halved. And over this period, we've grown not only less than the world average, but also by considerably less than other African and developing countries. As a result, our overall share of world export has shrunk from around 0.6% of total world exports 3 decades ago to 0.4% today. At the same time, imports have kind of jumped around a fair amount, but have remained more or less stable at 0.4% of overall world imports. It follows that if South Africa had merely retained its share of total world exports, overall exports would be about $50 billion higher today than they are currently. So what explains this disappointing historical export performance? And in the paper, Yash and I identify 4 categories, 4 possible explanatory variables. The first is South Africa's trade policy. The second is the structure of our trade. What do we trade and to whom? The third set of factors relate to the overall business environment. And finally, we touch on the potential contribution or role of industrial policy. So let me flip through each of these pretty quickly. Beginning with trade policy, South Africa undertook a range of quite aggressive trade policy reforms from 1991 until the early 2000s. And you can see that in the quite stark decline in not just our tariff rate, but the world tariff rate. But since then, not much has changed. So from 2004 onwards, South Africa's tariff has remained relatively stable. In fact, has increased over the last 5 years or so, mostly on agricultural traded products. We see a similar conservative approach to trade policy or trade negotiations. As part of the paper, we spoke to a range of experts in South Africa, but also to experts who sat on the opposite side of the table in trade policy negotiations with South Africa in Africa and at the WTO. And the general consensus was, despite the fact that South African negotiators are highly skilled and knowledgeable, South Africa seems unwilling to take a strongly progressive or leadership role in trade policy negotiations in Africa. And on the global scale, South Africa seems reluctant to participate in deep or meaningful negotiations on any of the new trade issues that are emerging on the international stage, such as e-commerce or domestic regulations. The net result of all of that is, following the first barrage of reforms, we saw a strong trade response. Imports grew strongly, but so too did exports. Over the last few decades, or the last decade, not much happening in the trade policy arena, not much happening on the trade policy agenda, and the export response is equally muted. Secondly, if we look at what South Africa produces and exports, exports are highly concentrated in raw materials and intermediate goods. And this hasn't changed much over the last few decades. Roughly 20% or more of South Africa's exports still accounted for by raw materials. The situation in Africa is somewhat different, we hear that African countries account for about 50% of South Africa's intermediate or processed exports. And you can see that here on this chart. SACU in particular, but also SADC and African countries are showing a much more diverse range of exports compared to South Africa's exports to the rest of the world. It is, however, important to acknowledge that most of these exports go to just 7 countries. So 70% of South Africa's total exports to the African continent go to the SACU countries plus Mozambique, Zambia, and Zimbabwe. But equally important to note that a very large percentage of this apparent export success story is in fact accounted for by retail, so the presence of South African retail firms on the continent. So a large number of exports, particularly consumer goods, are imported to South Africa. They are then re-exported to neighboring countries and are reflected as manufactured exports from South Africa. The third factor that we look at is the overall business environment, South Africa's overall competitiveness relative to the rest of the world. On this chart here, just showing South Africa's ranking on the World Bank doing business indicators, and you see we slipped dramatically over the last 20 years from a ranking of around 30 to over 80 in 2019, and you see a similar trend in most of the other global measures of international competitiveness. Digging deeper into these indicators, it's on the trade, on aspects related to trade costs or customs and related border barriers that South Africa tends to perform particularly poorly. And finally, we touch briefly on the potential role of industrial policy. South Africa pursues a quite aggressive industrial policy, which intentionally seeks to support domestic firms, to protect domestic firms, and grow domestic economy and jobs. But important to consider the long-term potential implications that such protection might have on South Africa's overall competitiveness. Also important to consider the impact of providing incentives to produce for the domestic economy relative to exporting. So just to summarize our main findings, there are clearly multiple reasons for South Africa's disappointing export performance over the last few decades. And we suggest that this includes the structure of the country's export basket, the high cost and deteriorating competitiveness of the overall business environment, but also the role that trade and industrial policy has in raising protection domestically and increasing the overall anti-export bias. Our recommendations are fourfold. Firstly, and most obviously, we need to take urgent steps to address the high cost of investment and trading across borders in South Africa. There's a number of interventions already underway to improve port efficiencies, to address problems in the rail and road transport sector, but clearly much more needs to be done to accelerate these kinds of reforms. Secondly, we need to consider the potential impact that existing industrial, localization, other sector-specific policies might have on export behavior. In order to offset the potential costs that policy might have, or the costs of producing and export to South Africa, we need to ensure that we have a comprehensive and targeted export promotion and export finance framework in place. And finally, it's time for an updated and comprehensive national trade policy. The last trade policy that was published by South Africa was put out in 2010. The world has changed quite dramatically over the last 10 years, more so over the last 2 years. And certainly a new policy is needed to guide South Africa through this new global environment, to develop credible and consistent positions on some of the new trade issues that we're confronted with in the continent and internationally, and to promote serious trade facilitation reforms within South Africa and across our borders. Thanks, Matthew. I look forward to the discussion.
Thanks very much, Matt. Yeah, that's another very quick overview of a paper that is available to read. Both these papers I've found to be very accessible, and for people looking to get a little deeper into these issues, I think they will provide quite a lot of value. So the main reason why we chose to have these papers together is because in a way you have the paper that we spoke to first, that really looks at the short-term dynamics, the kind of triage phase of the economic emergency and the social emergency that comes with it. And then we have a very nice kind of paper that looks at an important element of the recovery, or the rehabilitation phase for the economy, where hopefully we can recover in a way that serves our needs better and can provide far better and more equal economic opportunity to South Africans. So, that is how we are looking at those two papers, why we have put them together. To get some thoughts and reflections on the papers, but also the broader topic, I'm going to hand over to Monty and then to Marianne, and others are free to come in as and when they wish. The Q&A is open for anyone in the audience who wants to make a contribution. Thank you.
Thank you very much, Matthew, for inviting me. I'm honored to be here. I should note that I'm here in my personal capacity, and so my views don't necessarily reflect those of the IMF, its executive board, or management. Before I speak to the questions, the issues today, which are obviously very important for South Africa and other countries in the being studied. I thought I should put in context where the global economy is, where the conjuncture is, because it's quite relevant for this discussion. As a lot of you may know, the global economy is expected to grow this year by about 6% and about 5% next year. However, vaccine access has really been a major fault line and has led to divergence among countries. For example, there's been a marked decline in our projections for emerging and developing countries, and then a significant increase in the growth prospects for advanced economies. And this reflects in part the divergence in terms of faster than expected vaccination rates in advanced economies, and vice versa for developing countries. And of course, also massive fiscal support in advanced economies, roughly about 15% of GDP in increase in fiscal support, and compared to about less than 5% in emerging markets and less than 2% in low-income countries. So. And related to this discussion today, I think there's been at the individual level some vaccine hesitance in countries, but at the same time, there's also what I would characterize as a solidarity hesitancy at the international level and increased trade restrictions. But to be more specific as to the papers themselves, I'm very happy to comment very briefly on a few of the key messages from the papers. First of all, for the first paper, I was a bit constrained originally in terms of how much of a shelf life the paper would have on in estimating the impact of COVID on using the sums. It's an excellent paper, and it's methodologically absolutely top notch. I totally agree with the findings. The main concern I had was on going forward. What do you take from here? How do you assess the impact going forward on, at least at the sector level, in terms of the pandemic? What is likely to happen in the various sectors in terms of economic growth and employment? And I'm delighted that so far, at least, Sherman seems to be looking forward to doing additional work so as to extend the shelf life of this, and that's really very, very important, because on the current basis of the paper, you really can't extrapolate that much, given that a lot has changed, and you can't really assume that prices have remained more or less stable, because there's been a massive fiscal stimulus, monetary accommodation, which has led to significant price bubbles in stock prices and house prices, as well as the goods and services inflation, including in the United States. At the same time, commodity prices have also increased. So I'm very happy that Sherman is continuing and hoping to deliver even more interesting results going forward. So let me pause there. I'd rather give a chance to Marianne first to speak, and then I can talk about the other paper on trade policy, which frankly is closer to my heart than the sums, but or very, very interesting papers. Thanks.
Thanks. Over to you, Marianne.
Thank you so much, Matthew. And again, also thank you from my side for being part of this panel this afternoon. I also enjoyed the papers tremendously. And my kind of takeaway thoughts from them is that I think we all agree that our domestic economy is in the ICU, and that we need the economy to recover. And I think the only way in which we can do that is to focus beyond our borders. And we really need to look at our export competitiveness. I think Matthew's paper provides a nice overview of how our export structure, etc., and look at it over time, and showing that it hasn't really changed that much. So where my thoughts come in is to kind of look at our export competitiveness, but to look at it through the framework of economic complexity, to kind of make the statement that yes, we should diversify our exports, but at the same time, we should also increase the know-how and increase our capability to make more complex goods. So by saying this, I think it relates now back to that business environment that Matthew spoke about, in that in order for us to focus on such types of goods, we need to look at capabilities more specifically. And what I'm really interested in is these sectoral capabilities that is required, and anything that to that extent breaks these sectoral capabilities in order for sectors to then export and grow the economy. And then I think my second point also relates to this issue of localization. And I think in that sense, also to have a good understanding of capabilities, again, this resonates in localization as well, in the extent to which, what is the capabilities that we have in order to meet these localization requirements that are set up, and whether these capabilities are there in order to do so. So that's initially from my side. Thanks, Matthew.
Thank you, Marianne. There are already two very substantive questions in the Q&A that I think serve quite nicely for us to pick up on, and they're, I think, very firmly sit across the two papers that we have. The first one from Roberto is a question about how these papers might inform a view or a discussion about the basic income grant, or I guess a permanent increase in a substantial social grant, introduction of a substantial social grant, how the work by IFPRI might give us some guidance as to how we go about thinking about that. And I think that's a very important issue for us to come to. Sherman, I know that the paper does make some insightful observations about the importance of these kinds of grants and the time frame that you're looking at, but perhaps you can reflect on that work, but also the limits of the model in terms of contributing to policy choices like that, and perhaps how we can think about modeling this or developing policy around it going forward. Let's see how we go with that. And then there's also another very interesting and challenging question from Claire Bissica on the trade and export competitiveness side of things.
Well, just commenting on the basic income grant, that has been a staple of debate in South Africa for a long time. I remember when we were first working on the value-added tax in South Africa, the worry was, well, it's regressive. Can we offset it all with the basic income grant? At this point, in a COVID shocked economy and a pandemic shocked economy, my problem with the basic income grant is it's not focused enough. This has been a very specific shock hitting particular segments of the economy, and the income support needs to track those parts and should be much better targeted. The problem, and the other kind of overall problem with the basic income grant is it's very expensive. It's a budget buster. So my general reaction though at this point is you need to really worry about targeting, and that's hard. It's hard enough in Europe. It's not easy in South Africa, but that's the important part of this. So I guess that would be, and I think that's consistent with the particular South Africa work we've done that you heard about from Sherwin a couple weeks ago on the other work we are doing in a much more detailed South Africa model. And even that model is not detailed enough to dig down and really get into it. You have to get down into the weeds to really design these programs.
Thank you, Sherman. I mean, in terms of the paper itself, there is a section that shows the significance and importance of the social grant program, the social relief of distress program, and the TERS program that was introduced. I mean, could you give us a quick overview of what that looks like in the paper, and also how we might interpret that from a policy point of view?
In the South Africa work, we did more detail in the other papers that we've done on South Africa than we reported in the comparative paper. Basically, we were expecting to see a disaster at the bottom, and it was much less bad than we thought, because the South African support programs really helped. They really did offset a lot of the losses at the bottom end of the distribution. Targeting is an issue, so that came up, and the paper really, it's not something we can address with a fairly aggregated model. So, but it was interesting to see that the multiplier going down from the shock was less serious in South Africa than in other African countries we've worked in, for example. And really, because you do really have a major transfer program at work. I mean, beyond that, as I said, you really have to figure out targeting. If the basic income grant, there was a debate in South Africa years ago on would it lead to more capital investment at the bottom end of the distribution, et cetera, and I was feeling, again, my suspicion of that is rather than a basic income grant, which is really a blunt instrument, you really want to target that. If that's an issue, go after that issue. In terms of the COVID, but this is my general reaction to the bottom-up recession. We're seeing in a lot of countries now, people are trying to treat these as standard recessions, and that's not what's going on. In the US, for example, most of the inflation we're observing is very specific to supply chains. So used cars are shooting up, and they turn out to be a big number. Various supplies on certain kinds of like lumber, timber are shooting up. These are all very temporary. I mean, these are all supply bottleneck problems. And I'm sure you're seeing some similar things in South Africa. That's not normal inflation. That is a very temporal reaction of shortages that will sort itself out. Some of them may be structural. For example, in the US, all the restaurants are complaining that they can't hire workers. Well, it turned out those were lousy jobs without benefits and not treated well. And people have gone on and they're not really willing to go back. So that's probably, we'll observe a permanent rise in wages and perhaps benefits in those sectors, probably, which will raise prices, and that'll be a permanent adjustment in relative prices. That's not inflation in the sense that the IMF worries about it. So I guess that's where I come out on a lot of this.
Thanks very much, Sherman. And yeah, you're right. We did have, there is another paper that is part of the series. It was discussed at the previous event. I think it was about 3 weeks ago. That paper is also available on the IFPRI and the IFPRI website, and we got a link to it on the ERSA website too. The video for that conversation is available too. And that paper does make, have more profound, has a more profound interrogation with this question around the basic income grant, and certainly again the modeling form that has been adopted here is very useful for looking at short-term developments and contributions. But as you mentioned in your presentation, the question around medium and long term, but also financial constraints, is something that needs to be answered through a different approach to economic modeling of this kind of thing. Before I hand over to Matt to give some thoughts on the question about the 4 recommendations, whether they'll be adopted and how we might expect South Africa's export performance to evolve over the medium term. Monty, I got the feeling you wanted to say a few things about Matthew's paper. Do you want to make that contribution now, and then we can hand over to Matt Stern?
Yeah, thank you very much. I really liked the paper. And I broadly agree with the recommendations, and I also learned quite a lot of new facts which I didn't know. This is an area that I've personally worked on, and I wanted to highlight a few details perhaps that merit more attention, which he hasn't covered, but are in the paper, not in sufficient detail according to my assessment. For example, the role of the exchange rate in explaining South Africa's export performance. The paper finds that the exchange rate actually has progressively become less of a booster, or at least a decline in the real effective exchange rate has not helped South Africa very much over the years. This is indeed true, and there are possible explanations for that. And one explanation was advanced by a few colleagues of mine, Sandile Hlatswayo and Magna Saxegard, who found that there are what they call disconnects and dilutions in the relationship between the real effective exchange rate and export performance. And the key explanatory factor is the role of policy uncertainty. Policy uncertainty is a big factor in South Africa, because and anywhere else, frankly, because firms tend to adopt a wait and see attitude when it comes to making large export related fixed costs, because exporting is a is a costly endeavor. So you don't want to launch yourself into export markets without knowing what the your expected profits could be and the kind of risks they are. So having some degree of policy certainty is very, very important. And their paper shows that progressively there's been increasing, or there was increasing policy uncertainty, which is actually quite aligned with what happened post-global financial crisis, where you also had a significant amount of a much lower growth rate in the exports of South Africa. Another factor which is coming to the literature now is the issue of what is known as the dominant currency pricing, which basically means that if you're a significant proportion of your exports are actually priced in currency, are not priced in your own domestic currency, such as the dollar, for example, then you are in the short run, any depreciation of your currency is not going to make a big difference to your exports in terms of how competitive they are. So and especially in the current COVID environment, you are likely to get a huge boost to the economies in the short run. For instance, key sectors that would normally respond to export exchange rate movements, such as for instance tourism, are very unlikely to be stimulated by exchange rate movements because of the pandemic containment areas, because of pandemic containment measures. So let me pause there, and I have subsequently a few ideas also which you could talk about in terms of what the African free continental trade area could mean for South Africa, as well as general comments on intra-African trade, which the paper makes a lot of interesting remarks, and with which I frankly agree, but I could highlight a few other things as well. So let me pause there. Thanks.
Thank you, Monty. So Matt Stern, over to you. I think as we were just discussing, there's a terribly important role to addressing the short-term crisis, social and economic crisis that happens, and the programs that we've introduced probably have contributed very positively to alleviating some of that burden. We may have been able to do more, we may not. But once all that is said and done, one's still left with the hard task that has been with us for far too long now of breaking the structural characteristics of poverty and unemployment. We talk a lot about the role of exports in supporting global development and countries finding development. So with all of that as context, Claire asks some pretty permanent, challenging questions about how we might think about our prospects for making progress on the export front. Over to you.
Thanks, Matthew. Well, let me start with Claire's nasty question about the leadership of the DTIC. And Claire, let me start from the bottom up, going back to our recommendations. So firstly, in terms of a national trade policy, my understanding is there is work underway. And so the easy box is being ticked. The government is apparently working on a new trade policy strategy. What's in it or what it looks like is obviously what is critical in terms of addressing the kinds of constraints that we've raised. But let's at least wait and see. We have one tick there. In terms of the second recommendation from the bottom up, which was around export promotion, export finance, again, South Africa has reasonably mature programs in place to support exporters, both from a financial perspective, but also in terms of market information. So in principle, the programs are there. How well they work, how effective they are, whether they're targeting the right exporters or not is questionable. And so, yeah, probably a half tick there. You know, the programs are there, but they could certainly work better. I think that the trickier questions then are around the direction of trade and industrial policy and the business environment. So on trade and industrial policy, I don't foresee great changes from the current DTIC. The approach to both African and international negotiations is likely to remain very careful and conservative. And we're unlikely to push hard for major reforms either at the continental level or in international negotiations. You know, the suggestions came from most of the people that we spoke to is that South Africa tends to hold back progress rather than push for reform. And you know, similarly, when it comes to industrial policy, and so you know, picking up here also on some of the points made by Marianne on local content policy, you know, the overriding focus now is about how do we protect domestic industry, how do we cut imports, how do we insulate ourselves from the global economy, rather than about how do we try to encourage South African firms to get out there, how do we help them to be competitive, and how do we compete on the global scale. And so I'm not expecting big shifts there, which is disappointing when you look at our historical performance. You know, what the data shows is that we need a shakeup. What the business environment suggests is that we need major reforms, but the policy approach is likely to remain, you know, at best careful, at most protectionist. And then so finally talking to some of those, you know, those business reforms, you know, we are starting to see, you know, the right kind of noises around trade infrastructure, specifically the ports and the rail network. There does seem to be an increasing awareness that the logistics system is holding South Africa back. But you know, in order to make Transnet work better, in order to get our ports operating more efficiently, is going to take a huge amount of time, effort, and importantly, investment at a time when you know, fiscal resources are short. And so, you know, the sorry and sad response is I don't expect to see a marked change to our overall export performance. That doesn't mean we won't have good years. I mean, last year was, you know, surprisingly good from an export performance perspective. Mining and mineral products, as well as the agricultural sector, boomed despite, you know, extremely depressed global conditions. And so South African exporters are doing okay in the current environment. But if we want to see long-term structural changes, if we want to see, you know, a dramatic diversification in our export basket, if we want to see ourselves getting back to that, you know, hey, 0.6% of world exports, we're going to need to see, you know, much more significant policy and structural changes. And so then I'm going to try and address Monty's equally difficult questions. On the exchange rate, Monty, this is, you know, beyond my pay grade. I don't pretend to understand currency fluctuations and the rand, and certainly how they impact on trade. And so we've kind of copped out on that one a little bit. But you're absolutely right on the exchange rate, on the policy environment. You know, we're just touching on some of the potential drivers of trade performance. You know, we haven't got deep enough, and certainly more time and effort and work is required to understand how all of these factors, you know, actually contribute towards trade performance and what can be done to raise, you know, exports in the medium term.
Thanks very much, Matt. I'm going to open it up to Marianne, but also, you know, interested in anyone else's thoughts. Marianne and Matthew, I guess, but also Monty and Sherman. Please, Sherman, please feel free to come in on this. I mean, if I read the newspapers, which I do from time to time, I am left with the impression that the focus of economic attention is increasingly about the domestic economy. The ideas of export success and the role of exports in driving economic progress and income growth are less represented than they used to be. So in the reporting of what government is doing, that seems to be coming across quite strongly. Would that be a fairly kind of accurate assessment? And I think, Matt, that's part of what you are trying to say in the paper, that there's been a stagnation of certain elements of this policy environment, but also the infrastructure or the enabling environment around it. And then you've got that interesting data about how the structure of South African exports has not changed very much at all. How important is export-led development these days? Are we going down the wrong path based on global experience and the kind of state of economic research, by focusing so much on what is happening domestically and how we promote domestic consumption and production for domestic investment and consumption?
Matthew, that was a mouthful. I'm going to just give you my thoughts on it. So I do agree with Matthew's turn in that this movement towards protectionism is a slippery slope. And especially if you think about imports in conjunction with exports, in that we require imports and this local substitution or localization effect, I think will have severe consequences on both upstream and downstream industries. So without careful consideration about import tariffs and duties on certain goods, it will have devastating consequences. So for example, if you insert import tariffs on textiles, then that would affect the clothing industry and their price competitiveness in terms of exports. I also think that we need to take into account the complexity of global value chains. Some industries like food and beverages, they would be able to localize fairly easy, but more complex value chains, it would take a long time for us to be able to localize. And if you can import something that is of higher quality and of a cheaper price, should you not then do so in order to then add value or use that in your production process going forward? So I'm very concerned about this notion of inward looking and of not really focusing on what are the constraints to the capabilities of exporters. So Matthew talks about high-level constraints, but there are also product-specific constraints. So maybe some sectors struggling to get certain licenses or regulatory checks. So those things are kind of low-hanging fruit that can be dealt with in order to increase our exports. And then I think just to add to that, Monty mentioned the AFCFTA. I don't think that will be a panacea for our troubles, because it will take a very long time to get to full fruition. And added to that, the major problems there are non-tariff barriers. It's not tariffs. So maybe I will leave it at that for now. Thank you.
Thanks very much, Marianne.
Let me just concur with what Marianne just said. Indeed, first of all, to respond to your question, Matthew, on the issue of whether or not there has been a decline in focus towards more domestically oriented economic policy. I don't know for a fact, but I'm sure others in South Africa on the panel can better answer that question. However, I think the bigger point to make is that very few countries in the world have had successful long-term growth without exporting. very few exceptions, unless you're a very big country like the United States. The United States doesn't export that much relative to GDP, but almost all other countries that have been successful for very long periods of time have invariably relied on external demand, and South Africa is obviously not an exception. And it's true that what Marianne just said, the AfCFTA is potentially a game changer if and only if we get to address some of the most pressing issues, which have little to do with tariffs, as a matter of fact, and the evidence is there that tariffs don't make near as a big difference in promoting exports, because most of the we know for a fact that if that were true, then there would have been much bigger increases in exports, because like in the SADC, for example, it's virtually tariff free, and in all other sub-regional arrangements is similar, regional trading arrangements is similar the case. The biggest issue is frankly non-tariff bottlenecks, and policies to address those are really very important. And starting even by just establishing mechanisms to monitor and identify non-tariff barriers such as quotas, licenses, subsidies, rules of origin, phytosanitary measures, etc., and crucially trade facilitation, especially at the borders. I like the quote in Matthew Stern's paper on what happened at the border with the Limpopo, Bight Bridge, for example. Those frankly matter a lot more than trade tariffs, and without addressing those, really you are not going to make a big difference. So there's great promise from the FCTA, but it will take a very long time. And crucially, the focus should be more on the non-tariff barriers indeed. Thanks.
Yeah, I would like to come in on this too, and just really second Mumfor's point. Trade as an engine of growth has been and the trade growth relationship has been a debate in economics, but there are basically no examples of autarkic development strategies that lead to rapid growth. And the U.S., I think the traded sector is probably among the most dynamic parts of the U.S. economy, even though trade is only, 13, 14% of U.S. GDP. So we are more closed. Given from a South Africa perspective, your major trading partners are Europe and East and Southeast Asia. And you can think of East and Southeast Asia as an integrated economy, I mean, with value chains, et cetera, that run across that. It would make a lot of sense to pursue that further, especially in East and Southeast Asia. You want to get into those value chains. So if you're looking for places to look, joining CPTPP would be one interesting possibility, and getting involved in it. As Matthew has really focused on, a lot of the barriers are behind the border. It isn't just getting something across the international border. It's the business environment, et cetera. You need long-run stability in order to get investors to invest in these things. So joining something like CPTPP would be a commitment to that, which would then encourage the behind-the-border improvements that you really do need.
Thanks, Sherman. Matt Stern?
Yeah, Matt, a couple of points to add. I mean, firstly, absolutely agree with your original point that the focus on attention given to trade policy in South Africa seems to have dissipated dramatically. Trade policy used to be sexy. We used to have whole conferences. Now we're relegated to two of us sitting on an ERSA webinar. But yeah, in all seriousness, in the early 90s and 2000s, trade policy discussions were heated and hot, and there was a huge amount of engagement around where we were going and what we had to do next. At the moment, it really does seem to have gone pretty quiet. and you compare what, or the focus or the attention that's given to trade here compared to, for example, East Africa, where there seems to be an obsession with trade issues, trade matters, getting borders to work. There are a multitude of one-stop border posts, popping up all over East Africa. Back here, even within SACU, we don't have a single one-stop border shop in town. We have double borders across every border within the customs unit. And so again, the focus or the attention to trade, seems to have kind of gone off the boil. And the second point, which I think everyone's made, South Africa is the same size economically as Missouri. And sorry, Sherman, you'll have to help me out here. I know very little about Missouri, but we would not expect Missouri to grow and develop by selling to itself. And so as a small economy, the only way in which we are going to grow, the only way in which we are going to create jobs is by accessing international markets, is by linking into the value chains that Marianne has referred to. We're just not going to do it by trying to localize, by restricting South African or encouraging South African firms to sell domestically. And so, we need to find ways to, address these non-tariff barriers that everyone's spoken about. We need to find ways to incentivize, encourage South African exporters to get out there to compete. And to do that, we need to address the business environment, but we also need to rethink our policies environment and ensure that the policy signals that are put out by government are encouraging business to look outwards and export, rather than just to sell back into the South African market.
Thanks very much, guys. There's a question about the role in space for tradable services from South Africa. So if you wouldn't mind having a look at that, I'll come to it now. Sherman, before we do that, I've got a question for you. I mean, it may not be interesting, but you mentioned in your presentation that the role of social assistance and social protection in South Africa was relatively quite a lot higher than Mexico. And that you had kind of modeled, that was part of what you had modeled around. I'm wondering how that showed up in the modeling work. Did you find that contributed positively, or was it just a feature of the landscape of your model?
Well, actually, the models captured the existing social protection schemes. And as Sherwin noted, though, in South Africa, you had a social grant infrastructure in place when COVID hit, and then you could just turn it on. The U.S., for example, don't want to provide unemployment insurance, so they made it impossible, made it very difficult to ramp up. South Africa was able to tool up that system very quickly. Mexico had almost no institutional structure, so it was very difficult to react. So in the case of a shock that occurs in a month, you really have to rely on existing institutions, and you want to have them in place to do that. On the trade side, I think I'm following everybody else. I think it is absolutely crucial to get your house in order to do that. And I think, yes, the fact that you're the size of Missouri, I remember we were working on NAFTA and everybody was worrying about all the jobs that were going to go south to Mexico. And we made the point that the Mexican economy is the size of the economy of Los Angeles County. And therefore, it's hard to imagine that anything goes on in Mexico is going to have a great big effect on the US. But that means you are in a small open economy situation, and you really do, you shouldn't be ignoring trade. It is a major potential engine for growth, and there are not other ones around.
Yeah, cool. Thanks. Let's, 15 minutes left. I think I've got some inspiration for what I would like to ask of you each as your kind of last contribution, which would be a very short summary of the low-hanging fruits. Where is it that we're really just shooting ourselves in the foot and can we should be looking to make significant progress, or we would be able to make significant progress if we made the right choices. On the trade and services, anyone want to pick that up?
Yeah, Matt, don't get me started on trade and services. I understand. Okay, I'll keep it short. No, I mean, so firstly, I think, yeah, good comment, good question. Globally, we've seen dramatic increase in traded services over the last few decades, and likewise from South Africa. And so, not only in terms of conventional services like tourism or construction, but we've also seen South Africa growing as a destination for health tourism services, and we've all seen the rapid expansion of South African service providers across the continent. So you visit almost any country, certainly in Southern and Eastern Africa, you can find South African banks, retailers, fast food chains, insurance companies. Yeah. So it's certainly a massive growth prospect. What is frustrating from a policy perspective, it is also the one area where South Africa refused to negotiate or engage on. And so in trade agreement with the EU, South Africa has refused to, has effectively refused to engage in services negotiations. Potential negotiations with the US fell apart because South Africa was not willing to engage on services. In SADC regional and on the AFCFTA level, we pushed a very conservative approach to services negotiations, despite the fact that this seems to be an area where South Africa is an obvious advantage to the continent. So yeah, huge opportunities. Can kind of get it that with the global north, that South Africa is at least reluctant or careful. But on the continent, the opportunities are immense, and I would certainly expect and want to see South Africa play a much more proactive role in pushing for a deeper services reform agenda.
Marianne, you want to come in on this, or you think that Matt has broadly covered?
Yes, no, I concur with Matt, but I think we really need to emphasize industries with large spillover effects, with a lot of upstream and downstream industries, in order to deal with large unemployment and poverty, as Matthew said. So while services are important and there's great potential, I think we need to find places that can absorb labor.
Cool. I mean, one of the concerns I have in listening to the conversation is, and I think it comes across well in your paper and your presentation, Matt, is, there's obviously a lot that can be done in terms of getting trade policy right and getting the infrastructure around trade right. But fundamentally, you do need a competitive business environment that is able to produce competitively, not just to compete with imports, but also to compete on the international stage. There are no doubt any number of other things that need to be worked out in order to facilitate that. And it seems like with every passing day, the list of things that need to be done or caught up on gets longer and longer. But yeah, as I mentioned, as a wrap up, would be very interested in hearing from you guys where the opportunities lie in terms of implementable, reasonably short-term interventions that could be made should someone have the willingness and agency to do so. I wonder who I should start with. I mean, it's a little unfair, I suppose. I mean, Monty, should we get you out of the way, because you are associated with a very substantial brand that deals, and despite your attempts to anonymize yourself at the beginning, let's hear what you have to say, and then we can pick on a South African, and then over to Sherman, and then I'll find another South African to wrap it all up with. Monty?
Yeah, since you mentioned a few hanging fruits, low-hanging fruits. I used to talk about low-hanging fruits a long time ago in South Africa, but yeah, the biggest one I think is the issue of policy uncertainty. So as I mentioned, in relation to export performance, without policy certainty or greater policy certainty, you will not have adequate investment, both for domestic purposes as well as for exports. And also, and this is actually well documented in South Africa, that there's a very close correlation between the policy uncertainty and the growth of investment. So without addressing that kind of uncertainty, you are unlikely to increase exports and long-term growth more generally. So that's, I think, something which needs to be addressed in order to boost confidence. But of course, you need to get the basics right, including and especially the availability of energy, reliable energy, especially electricity, by expanding the availability of and allowing other players to enter the market. I think the government is already doing that, and that's a good thing. Whether it can be accelerated, of course, remains to be seen, but it's definitely steps in the right direction. And so those are the two measures that are relatively straightforward. Well, relatively, at least can be done in the next couple, maybe 1.5 years. I think you can definitely try and improve on. So let me pause there. Thanks.
Thanks, Monty. Marianne?
Thank you. Yes, Monty, absolutely. Those capacity things that constrain capacity is absolutely necessary. But in order to, I think, low-hanging fruits, I think, again, this notion of economic complexity brings a great dimension to it. So you think about the product space, and you think about products that we are already producing and exporting, and think about what's maybe breaking the successful exports of those products. And then also think about products that are closely related or closely distanced to these types of products. In other words, where you already have capabilities in order to produce them. So that you diversify, but that you also diversify into increasingly more complex goods. And so I think a great paper to reference here is one by Professor Borat from UCT, where he speaks about frontier products. And it's also kind of noted on the Harvard's Atlas of Complexity Index. Those types of frontier products is where we have capabilities. We just need to get on and start producing and exporting these products.
Sherman, thank you very much, Marianne. Sherman, from your perspective.
A couple of points. Let me second Montfort's statement about the energy sector. I mean, that is really crucial. Infrastructure, very important. IFPRI's been doing some work on the use of renewables in South Africa, and a lot of it is that you really need to get an organized, consistent energy policy that doesn't subsidize coal. And you're heading in that direction, but it's absolutely crucial for industrial development in the country. On the trade, I guess the points I would make is that your major trading partners are the EU and Asia, East and Southeast Asia, not South Asia, not India. You want to make, you really want to do a serious commitment to that, which is what I said, join CPTPP, I meant it, and also deeper relations with the EU would be. It would also help in the short run, you could actually illustrate a much stronger commitment to trade by becoming a productive member of the WTO. and trying to actually be a positive force for reform of WTO rather than their current state, which is not turning out not to be very helpful at the WTO. So those would be basically commitments to trade and what that involves.
Thank you very much, Sherman. Matthew Stern.
Thanks,
Last
Matt.
from you.
Thanks. I'm going to take inspiration from Glenn Robbins in the chat, and who points to one low but very large and heavy fruit, which is Transnet. A lot of the conversation has been around the fact that tariffs are, yeah, they're a pain, but they're not the real constraint to accessing international markets. If we want to be able to compete globally, we need to get stuff from the producer to the port, from the port through the port terminal, and into the out to the rest of the world. And that entire logistic chain is monopolized by Transnet, and it's not working particularly well. And so, big opportunity is to do an ESCOM on Transnet, carry through with the intended breakup, and get competition into our rail and our port system as quickly as possible. Because if our, unless our logistics system is working and working competitively, it's going to be very difficult to see how we're going to transform at least our export economy over the medium term.
Thank you very much, Matt. I think that's a very nice kind of action that we can end on. So I guess what remains for me to do is to thank very, very much the discussants that have joined us today, Sherman, Monty, Marianne, and Matthew Stern. Also to recognize the contribution of the co-authors in the papers that Matthew and Sherman were involved in. To thank IFPRI and also the GIZ for the collaboration that we've had around this. This is the third of 4 events. The other 2 are, there is a resource page on the ERSA website that'll include a video as well as papers and a couple of podcasts put together by Margot and some of the authors. There's a 4th one. We'll be doing it on the 1st of September, I believe, and we're going to be looking a little bit more into the longer term future, kind of structural issues related to growth and recovery, pulling from the first 3 seasons. This event has been recorded, and a recording of it will be going up overnight or first thing tomorrow morning. Let me see if there's anything else that Margot has reminded me to say. We are trying to get some feedback from people about how your experience of these webinars goes, what it is you're looking for, whether you felt you got it. And that will be popping up as you close, and there might be some communication in your inbox around that going forward. So that is 4:59. I think it's the first time I've ever ended something like this early. Thank you very much, everybody, for your attention and contributions. And thank you to the audience. Cheers. Have a good evening.